think we'll go ahead and get started here. Thank you everyone for hopping on today for our second in this series of charting your financial future, talking about money management for artists and creative professionals, creative small businesses. Today's webinar will focus on credit. Oh my gosh, such an important topic. I am so excited. I'm Meredith Badler. I'm the Deputy Director at the CBCA, which is the Colorado Business Committee for the Arts. We're a nonprofit organization that focuses on advancing our creative economy here in Colorado through the connections of arts and business. And we are just so excited to be partnered with one of our Colorado businesses, the wonderful Ent Credit Union, who has been partnering with us on this series and will be leading today's webinar, talking about credit. A few housekeeping items as we get started here. This is being hosted live on the Zoom webinar platform. So for those of you that are joining us, your mic is turned off, your camera is turned off. That'll help you really just focus on the terrific content that we'll be getting through today. But we still want to hear from you. So go ahead and find your chat box, open that up, and let's say hello. Let us know who you are. I encourage you to send those messages to all panelists and all attendees. If you send it to all panelists, us and our speakers will see it. If you include all attendees, then everyone will get to know who you are. Let us know where you're joining from, what you do. That'll just also help our speakers get a sense of who's in the room today. And if you have questions, and I am sure you will, and we want to make sure we answer them, there's a nifty Q&A feature that will make sure your questions don't get lost in the chat. Our speakers will be able to see them. So feel free throughout the presentation, populate that Q&A. You don't have to wait till the end. As you think of questions, put them there. We are recording today's presentation. That recording will be shared afterwards with you via email. It will also be posted on CBCA's website. We have a beautiful new resource library, so it will live there and be easy to find. We love our resource library. If you missed last week's webinar, so this is a series of 3. Last week, we talked about budgeting and just mapping out your financial future. You can go back and re-watch or watch for the first time that recording. If you're watching this one live on YouTube, hello to you. So I think that, and then we have one more coming up next week, talking about big financial decisions. I think those are all of my comments. I'm gonna go ahead and stop sharing my screen, and maybe I'll kick it to you, Mike, and if Tracy's able to join, we'll make sure to get her connected. Go ahead.
Absolutely, thank you. Thank you very much. So just quick introductions before we dive into today's content. My name is Mike Viersba. I am the Community Educator Program Lead over at Ent Credit Union. A little bit of background, just so you guys kind of know who you're talking to here. I've got about 6 years in the financial industry, spread across both banks and credit unions, from frontline staff and lending, back office side of things, and over into education. So I've kind of seen finances from a lot of different sides and tried to go out there and learn as much as I can so I can pass it on and share all of that with you. You know, I love groups like this. My wife has graduated from CSU with her degree in fine arts photography and has her business. So it's definitely something that matters a lot to me, and to see people who are able to create that beauty that I just have never had the talent for has always been an awesome experience for me. So I'm happy to be here with all of you today and share this really important information. I'm going to pass it over to my co-speaker here, Katie, and let her introduce herself as well.
Hey, good afternoon, everyone. Thanks so much for joining us today. For those of you that weren't here for last week, I'll reintroduce myself again. My name is Katie. I am the Community Education Coordinator for Ent Credit Union. Been with Ent for about 4 years now, but I've been in the financial industry for a little over 12 years. And the majority of that time has been spent working in the branches. And that has been a really great opportunity to be able to see a lot of different situations and scenarios and ways that we're able to help our members out. And when I'm not at work, I love to focus on all things wellness. So physical wellness with running and hiking and stuff like that, and mental wellness with meditation. And the reason I bring that up is because oftentimes we forget how important financial wellness is. And it can be a lot harder to focus on other areas of wellness when we don't have that financial wellness part down. And so that's why I love coming to hang out with y'all and do these classes. But today we're talking all things credit. So hang on, we've got a lot of information that we're going to go through today. We're going to talk about what credit is, who looks at it, what affects it, and how you can build it. So to get started, what is your credit score? What is this? So your credit score is generated by this super complicated algorithm that's probably only a handful of people actually really understand. But simply put, your credit score is a numerical value for trust. Right, you're going to hear that word a lot today. So it's a numerical value for trust. So how much can I trust you to follow through on your end of whatever agreement it is that we are entering? And the higher your credit score is, the more financial institutions and service providers are going to trust you. And this level of trust is considered in a lot of different situations. It's more than just applying for a loan. So if y'all want to throw it in the chat, what else do you think that your credit score influences? I'll give y'all a second. Any takers? Job opportunities, background checks. Yep. Insurance. Yeah, y'all are getting spot on. So yes, your credit is going to affect lending. That is going to affect your interest rates and your loan term. And those things are going to affect your monthly payments, and what that looks like. But there's so much more than that. Your credit is going to affect your ability to, rent a home. A couple years ago, my parents were going through a pretty rough patch, and they had to get out of their house and find an apartment. And they had a really, really hard time because a lot of apartment complexes were denying their application because they had poor credit at that time. And, that's just a really difficult situation to try to work through. And then somebody mentioned job applications, 100%. Employers, they will pull credits. And when they do this, when employers are doing this, they're pulling what's called a soft pull on your credit. So this is not actually affecting your credit score in any way. They're taking a peek at it. And again, they are evaluating this level of trust. They're trying to determine of their, applicants, who they can trust more, who they might go with for the hire. But it's not just that, their list just keeps on going. So you also mentioned insurance. Yeah, absolutely. Insurance companies. So it actually costs more money to drive your car if you have poor credit, because insurance companies, they see that those with poor credit as more of a risk because those folks tend to file more claims. And so they're trying to cover themselves. So it's going to cost more money for you to drive your car down the streets. And utility companies, if you're moving into your new place, you need to get your utilities turned on. If you have good credit, then it's probably just a flip of a switch and you have access to everything. But if you have poor credit, there's a good chance that they're going to require a deposit to be put down before they'll turn your utilities on. Y'all, moving is already expensive enough without adding on extra deposits, on top of that. And if you're in the military, you can actually lose your security clearance if you have poor credit. They're going to view you as more of a risk. So again, it all comes down to that level of trust. In all of these examples, the financial institutions, the organizations, the businesses, they're all trying to determine how much that they can trust you. So we know a lot of people are looking at this magic number here. So I'm going to turn it over to Mike, and he's going to dive in a little bit deeper into the bureaus and how this numbers coming up.
So actually in the chat there, we did have Lori ask an awesome question. What she asked was, why is what a loan officer sees different from what a consumer can see, and how is the FICO score determined? So that is an amazing question, and that's why we're here. The crazy thing is, you just kind of ask like 4 different questions in one. And so the first piece of that question is kind of going to have to be layered behind a couple of other pieces of information. Because to understand a credit score truly, and to be able to know exactly what you're looking at, how it works, and how to use it properly, you have to start from square one. And oddly enough, square one is going to be the credit bureaus. So there's 3 different credit bureaus. There's going to be TransUnion, there's going to be Equifax, and there is Experian. When we're thinking about these 3 different bureaus and what they represent, they're kind of just the recording devices of credit. They're really just looking at all the information that gets sent to them, and then they file it away and they store it. So all of the information that's coming their way is what's used to create that credit score. Couple things that make it confusing though, is that the information that's being sent to them isn't always being sent to all of them. So when we think of the information that's going over, it's going to be anything on a credit line. So your credit cards, mortgages, and car loans, if you've got lines of credit or student loans, all these different pieces of information are going to be sent. Again, you may have a credit card that only sends that information to TransUnion, or your car loan may only be being sent to Experian. So that is the first gap, the first kind of break in the chain that's going to show why you can get a different score from different places. So again, Lori, that's just going to be that first part of the question, right? Is why is what a loan officer sees different from what we see? Well, that's one of many answers we're going to be going over, is that you may be looking at TransUnion, they may be looking at Equifax. So all of these things can determine part of why that separation is. But again, that's only the first of a ton of different pieces. When we're thinking about the second piece of that, we're thinking about what the actual scores are and what the scoring models are. So FICO is the primary one that you're going to think of. FICO actually stands for the Fair Isaac Company. Now it is the corporation. And don't let it trip you up there. Fair has nothing to do with the system that it's built on. It's who helped originate it, who helped found that program. But that creates the second disconnect, is there is 2 major players in the game of what score you're looking at. So you may be looking at a FICO, or you may be looking at a Vantage score. If you're thinking of all the free scores that we see, so our Credit Karmas, our Savvy Monies, our MyFICO, all of these different groups, they're generally going to be passing you information based on the Vantage model. Whereas most lenders, that's going to be your financial institutions or specific auto lenders and things like that, are going to be basing it off of the FICO model. So while they're very similar, they have a little bit different weights and different calculations in how they see your score. So that creates the second disconnect. When we're thinking about the third disconnect, it can go even deeper than that. Even within FICO, you can have different scores. Sorry, what you guys are going to see here is Equifax is coming in and spitting out one score, TransUnion spitting out another, and Experian is spitting out another. And the reason that happens is because different information is being plugged in. But you can actually see Equifax going through FICO and coming out with a 720, and then Equifax going through and coming out with a 730. It's because they may be using a different scoring model. So the original FICO model was the FICO score. Since then, there's been version 2 and 3 and 4, and it's kept going. Currently, the most frequently used model by lenders and by service providers is the FICO 9. They're already releasing FICO 10, but that's going to shift that scale. So again, what else can create the difference from what you see and what they see? Well, maybe you were looking at FICO 7 and they're looking at FICO 9. And there's these minute changes that they're trying to update and upgrade to make sure that your score is the most accurate representation of your financial trust. Again, we're going to be tying back to that trust repeatedly throughout this class, but these models have been shifting over time to try and better grasp what that trust really looks like. The best example I can give is going to be the biggest shift in recent history. I was going from FICO 7 to FICO 8. That changed a lot of the weighting behind some of the collection models, specifically medical collections. So when we're thinking about trust, how much can I trust you? Well, collection or a delinquent loan that you may have is going to be one of the biggest factors in that. Right? If you aren't paying back this person, why, how am I going to be able to trust you when you ask me for that money? But it changes, right? It's different based on the scenario that collection happened in. If we're making the decision to buy a new vehicle and then we're unable to actually handle that financial responsibility and that's repossessed, that's going to weigh more heavily. It used to weigh exactly the same, but now since FICO 8, when we're thinking about medical collections, even though both of them are being reported as that collection on your account, the vehicle repossession is going to hurt your score more, bring you down lower than a medical collection, because that medical collection is really, by definition, life happens. That was not a financial decision we made. No one said, I'd really like to get sick right now. I think it sounds like an awesome plan. I'd love to not be able to work and to fall behind. So they want to be representative of that. So it's going to constantly be changing. A few years from now, we might already be on FICO 11 because they're figuring out more and more of these pieces that say, okay, if we look at it through this lens, maybe it's more accurate. So why is what you see different? Well, it's all of those pieces. It's looking at, are you pulling the same bureau? Are you looking at Equifax and they're looking at TransUnion? Are you looking at Vantage and they're looking at FICO? Are you looking at version 7 and they're looking at version 9? All of these can create that disconnect in the exact score that you see and what they see. And it makes it difficult to truly understand right where you are and exactly how well you're doing in that scoring model. But the other thing that makes it really confusing is, so you see these numbers, right? It spit out a 720 or a 710. What does that even mean? And we all kind of have these ideas of what is good credit, what is bad credit. But another idea of why they're different in the first place is understanding what is the actual range. So we do have another question here I see from Meredith, just how different will these scores be? So in most cases, it will be variations of maybe 15 to 20 points. And 15 to 20 points, depending on exactly where you are in the scale, may not matter, or it may matter a lot. So we'll be touching on that here in just a second. The times when that can vary greatly, though, the times where you will get that separation of 50, 60, 80 points even, is what is the difference in what's being recorded. So if you're looking at FICO 8 versus FICO 9, the difference may be pretty minor. If you're looking at TransUnion versus Experian, they should be pretty similar, unless TransUnion is the only place that sees that you had a vehicle repossessed and Experian doesn't. So if Experian didn't see that, your score is going to be much higher there. So how different will they be? Most of the time, they'll be pretty similar. A few points here and there, maybe up to 15 or so, maybe 20 tops. Where the big shift can come is if they don't all have the same information. Also, if you're just new to credit, that can make a big difference because some of them may have information that says, yeah, you've done quite a few things. And someone else has information that all you've done is this one loan or this one credit card. So in most cases, to answer your question, variation will be pretty small. The goal is single digits. That's what they love to achieve, maybe just over 10. It can be greater based on why they're seeing that different information. But to get a better idea of what those ranges look like, it's odd to know that the scores are not on a scale of 0 to whatever. They're on a scale of 300 to 850. Does anyone have an idea? I want you to throw it in the chat. What is the bad score range in essence? If you are under what number, you're considered to have bad credit. You're going to have a really hard time actually being approved for credit cards or loans or anything like that. What do all of you think from just the experience you have? Below 675, okay. Anybody else? I'm gonna drag some information out of you guys here. I gotta have a conversation. It's the best way to learn. So what do you guys think? So far, we've got the below 675, below 600, couple under 600. Looks like a pretty good consensus there around that 600 range. And you're all pretty much right. The average that we're looking at is going to be in that 700 range. I always like to throw this in there because it's a little boost to confidence. Colorado, we're already beating the average. We're doing well. That 703 being the bar that's set, how far away from that is that bottom range? You guys were really close. So in this model, they're saying about 580 and below is considered poor credit. That's really going to depend on who you're asking, though. What lender are you talking to? What service provider are you asking? They may say 600, they may say 580, they may say 550. But most of the time, that line in the sand for poor credit, bad credit, lands between that 600 and 550. If you're in this range, means you will likely be automatically denied when you apply for different things. So it can be a really hard spot to get out of. There are ways, and we'll talk about those later in the class. If you fall into this range, how can I climb out? How can I move myself beyond this range? So once you are beyond that range and you're looking in that fair to good range, you're really falling anywhere from that 550, 600 up to 740. This area means that you're taking care of your finances. Maybe you've had a couple hiccups here or there. Your past could be a little spotty in recent history. But for the most part, you've got a good chance of being approved for the things that you need. Maybe not everything that you want, but you should be approved for the things that you need. The cost of that is exactly that. It's the cost. Generally, you're not going to be approved for as much, and you're going to be paying a higher interest rate for whatever you are approved for. The other area here is exactly what I said before, though. It's need. When you're going for those wants, you need to be closer to that 740. Because once you move past that 740, you're really looking at that very good or exceptional credit. This is where the scores are doing extremely well. You're going to be approved unless you are financially strapped in a way that you can't really take on this additional responsibility, even though they think that they would trust you to do it, but your finances say you truly may not be capable. And that's where in lending, debt to income ratio and things like that will come into play. And so that is one thing to always keep in mind as someone who is kind of in the arts sector and who is a lot of the times, running that business. You're a business owner and you're kind of trying to figure out exactly how your money is going to work for you. Something to keep in mind is when you're filing, especially for taxes, that is declaring how much money you make. It's not how much money your business brings in necessarily. However much you're reporting is what's going to be used in the majority of lending scenarios and when it comes to your credit. So when you're applying for that car or that card, when you're going in and applying for that apartment or that home loan, all of these are going to tie back to that debt to income ratio. So even if you're in this A+ credit, even if you're doing phenomenal and you're really making sure that people trust you, make sure that you're not underselling yourself too much when you're making those payments to yourself out of a business, or it can hurt you come that time when you need help. It's really hard nowadays to be able to afford a car with cash or to make some of the big financial decisions that we have to make. You know, we think about the housing market in Colorado is insane. So we're needing that help. That's when we need these credit scores so that we can be approved, take out the loans for the things that we need. But this being that exceptional credit, does anyone have a guess? Throw it in the chat again for what do you think the difference is between that green and blue, right? Someone who's a 745 and someone who is an 805. What difference does it make? If you're under 600, you may be automatically denied. If you're somewhere in the middle, you will probably pay more, but you can get what you need. What's the difference between that 740 range and that 800 range? See what you all think. So the interest rate you'll get, higher lines of credit, or better chance of securing good loan offers. So Justin, you've got it pretty close there. But really when it boils down to it, it's bragging rights and room for error. These are all considered A+. When you're looking at it from a lender's perspective, you have credit tiers. This is going to be saying A+, A, B, C, and D tier credit. 740 and above is all A+. So the difference there is really going to boil down to bragging rights and room for error. If you're a 745 and you make a mistake, you're not going to be in that A+ range anymore. If you're an 805 and you make that mistake, you can probably keep that A+ rating. The other thing is, of course, bragging rights. You know, if you beat your significant other by 6 points, you can remind them that you beat them by 6 points. I know that's the biggest thing for me. You know, it's always great. When my wife, when we first got together, she didn't really. I was signing on everything with her. When we got her car, I signed with her. When she was trying to move into apartments, I signed with her. Essentially, credits together. And later on, we went to sign on something, and she was ahead of me. It's a very bitter feeling. I built your credit. What is this? How are you ahead of me? And I've since jumped back and forth with her, and whoever's got the lead at that moment, yeah, that's something that, you know, you're just waiting for the next time you got to apply to hope that you take the lead. So I see that you guys are the same way. I see that. Absolutely bragged. It's important, you know, bragging rights. You got to be the best. So the other thing I did see in here that I do want to reference is going to be, I believe someone said the better chances for things like reverse mortgages. Reverse mortgages are a whole nother animal. They honestly kind of deserve a class in and of themselves. So they are just like most other loans, though, that your approval is going to be based on a number of factors, and A+ really is A+. So only learned this year. Lori says that she only learned this year that it was impossible to have a good credit score without a credit card. That is actually a perfect segue, and I appreciate you so much for doing that, because what I'm going to be doing now is handing it over to Katie to break down the next piece. We've talked about why the credit scores are different and what they really mean and what those numbers are. But that's all great knowledge. Katie's going to teach you how to actually get that 740 plus.
All right, thanks, Mike. So at the beginning of the class, I mentioned that your credit score is calculated using this crazy math equation. And the good news is that we don't really have to understand that crazy equation, because we have this fantastic pie chart here that really simply breaks down the 5 factors that are considered when your credit score is being generated. So we're going to go through each of these individually, and starting off with the one that makes the biggest impact, which is going to be your payment history. Payment history weighs more heavily than anything else when it comes to what your credit score is. You know, they're looking at, can you make your payments and can you make them on time? You know, it seems easy, you know, when you say it like that, but you know, that can be more of a challenge. But that's going to be something that you really want to focus on, because it weighs so heavily in that score. And we'll talk more about this in a minute, but you're going to make things a lot easier on yourself if you don't overspend and put yourself in a situation where you can't keep up with those payments. You know, so especially with, you know, fluctuating income, you know, go back to the last class with budgeting, you creating that budget, understanding what you like, what your baseline is and what you can afford to spend each month, so that you don't find yourself in a situation where you can't make those payments, because this is so important to focus on. And whether you have one payment or 10 payments that you're trying to keep track of, you set yourself reminders, utilize automatic payments, you know, do whatever you need to do, but just make sure, you know, that you're staying on top of that. And if you are a day or two late on a payment, you know, it's going to be okay. You know, don't stress about it. I've seen that a lot working in the branches. You know, they'll have a member come running in because they're a couple of days late on their loan payment and they're super stressed out. And the question we hear every single time is this going to affect my credit? And so the answer is no. So late payments aren't going to hurt your credit until you get to the 30-day delinquent period. So if you're a couple days late, you know, most you're going to run into is a late fee from your institution. And even then, a lot of institutions have a grace period where you can still make your payment without getting charged that late fee. But it's not going to negatively impact your credit score until you get to those 30-day delinquent period. And while you do have that 30-day window, you know, before a late payment is reported, you know, you still want to try to make your payments on time. And if you can, even make them a little bit early. You know, Mike's going to go into that a little bit later about why making those payments early can be so impactful. But for now, we're going to go to the next most important category, which is utilization. So utilization is a fancy way of saying how much of your revolving credit are you using and carrying over from month to month. So again, this is revolving credit. So we're looking at credit cards, lines of credit, things like that. And it's also your carried balances. So if you utilize a certain amount of your credit card, but then you pay it off that month, that's fantastic. For this, we're looking at how much you're using, what you didn't pay, and then what is then being carried over into the next month. So for example, you have a credit card that has a $500 limit and you use $100 of it, you don't pay it, it gets carried over to the next month. So you've then utilized 20% of your available credit. Let's say that same credit card actually had a limit of $2,000. You spend the same $100, you don't pay it, it carries over to the next month. In that case, you're only utilizing 5%. So when it comes to utilization, we have 3 stages with utilization. The first stage is you are using some of your credit, you're making payments on it, things are going good, carrying over a little bit, and you're actually helping build your credit. Stage 2 is you're using a little bit more and carrying over a little bit more, and it's not really helping anything, it's not really hurting anything either. And then we get to stage 3, and stage 3 is the danger zone. So in this case, you are over utilizing your available credit. You're spending more, you are relying on your credit to live. And now you're considered more of a risk, because now there is the question of, can this person pay this back? So when it comes to those different levels, throw it in the chat. What do you think is that line that you want to stay over when you're carrying balances over from month to month? It's going to be percentage. So how much do you think it's still okay to carry over? And Mike, if you'll help me with C in the chat. So what do y'all think?
So we've got a 20% and a 30% so far, 10 to 15%, 25%.
Okay. Yeah, y'all are
30.
nice. Yep. I'll go ahead and give it away. That 30%, that's the magic number right there. So if you are utilizing and carrying over to the next month up to 30% of your available credit, it's okay. And you're making payments on it, like you're actually helping build your credit if you're staying under that 30% line. Now, again, throw it in the chat. What do you think that line is that you don't want to cross? At this point, you are entering the danger zone. You don't want to carry over any more than this amount. What do y'all think?
$60 and a few people throwing in 50.
Okay. Yep, 50 is right. Yeah, so 50%, that is entering that level 3. So up to 30% carrying over, you're good. You're actually helping build your credit. Between 30 and 50%, that's that middle range where if you're carrying over in that area, it's not helping anything. It's also not hurting anything. It's just kind of meh. But when you cross over that 50%, so you are spending and carrying over 50% or more on balances of your available credit, that is when it is really going to hurt, and it is going to hurt bad. So that is that line you want to try to avoid at all costs. All right, so we know that that 50% line is what we want to avoid. So let me ask y'all a question. Do you think that there is a difference between utilizing 99% and utilizing 100%? What do y'all think? Do you think there's much of a difference between those two?
Yeah, one that says yes, there probably is. Yes.
Yep. All right. So it's a little bit of a trick question. So if you utilize 99% and you pay it off that month so that you're not carrying anything over, you're good to go. If you utilize 99% and carry that over, then that is, that danger zone, the over 50%. But if y'all use 100%, that gets reported to the credit bureaus immediately, like the second it happens. So they don't care if you were planning on paying it off that month. If you're planning on paying it off or carry it over, it doesn't matter. As soon as you hit that 100% utilization, then that is going to get reported right away. So you want to try to avoid maxing out any credit cards or lines of credit, things like that you have, because that is going to hurt your credit really bad. And so I mentioned, Mike is going to talk to you a little bit later about why paying early is important and its impacts with your utilization also. And I know I keep teasing y'all with this information. I promise Mike is going to get to it. But for now, we are going to move on to the next piece of the pie, which is that length of credit. So it takes time to build credit, whether you are starting from scratch or whether you're rebuilding it, it's going to take some time. So you just have to be patient and allow yourself that time to get it up. And you remember, it all comes back to trust. We're talking about length of credit. Let's say, for example, that you want to learn how to ski and you have 2 ski instructors. One has been skiing for 7 days and the other one has been skiing for 7 years. Which of those 2 are you going to trust more? And when it comes to length of credit, what's the magic number between 7 days of history and 7 years worth of history? We're not really sure, what that magic number is, but we do know that some history is better than none. And then the more history that you have, the better it's going to help you. And different types of credit hang around for different lengths of time. Your revolving credit, like your credit cards and line of credit, that's going to hang around on your credit for as long as you keep it open. Things like car loans or student loans, which are installment loans, installment credit, those, once they're paid off and paid in full, they'll hang around on your credit for 10 years, helping you out. And then after 10 years, it's going to fall off and disappear, and it's like it never even happened. So that's why we always like to recommend that start out with some kind of revolving credit, because it can stay open forever. Get a car, just put some gas on it every month and pay it off. Whatever type of revolving credit you can use to start, extending that length of credit. Nobody told me that when I was in my early 20s. I had, in my early 20s, I had a couple retail credit cards and I wasn't really using them. So I closed them, because I was always under the impression that if you have an open credit card and you're not using it, then it's hurting you. And that's not the case. So fast forward a couple years, my husband and I were getting married. We get a joint credit card so we could start racking up some miles for travel. So now my length of credit is 10 years long, where it should have been 15 years long. But it's not, because I closed out those initial cards that I had opened up, because I was misinformed, I didn't know any better. But if you have that revolving credit, it's just hanging out there, and even if you're not using it, like, it's okay. It's going to continue to help you still. But before you can have that revolving credit working for you, you have to apply for it, which takes us to new credits. So as I mentioned earlier, when dealing with job applications, landlords, utility companies, things like that, that is just a soft pull, and it's not actually affecting your score in any way. They're just taking a look at it. But when you put an application in for something, that is a hard inquiry on your credit. And those inquiries will stay on your credit for 2 years, but they're going to have the biggest impact in the first 6 months. So, we always recommend, if you can wait 6 months in between applying for things, you're really going to be helping yourself out. Because when you apply for something, and we all have to apply for something, we all have to apply for new credit. You put that first application in, it's going to hurt a little bit. And just, mostly in those first 6 months. But then if you go out the next month and get, a credit card for Target, that next month, that hit is going to hit more than the first one. And let's say the month after that, you apply for a line of credit or something, and then that hit is going to hurt even more than the one before. And it's just going to keep stacking on top of each other, and each hit is going to be worse than the last, unless you can wait that 6 month period, and then it's not going to be as bad. And so I remember I mentioned last class that last year I bought a townhouse, and I remember when we were working with our mortgage loan officer, she was practically begging us, like, please, 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 please do not apply for anything while we're going through this mortgage loan process, because she knew how much, another inquiry would affect my credit that they had already pulled and were working on for that mortgage loan. And so remember, it's going to take time to build that credit. And every new line of credit isn't going to be as good as the last until you have that history behind it. You establish that history, showing that you can manage it well. You're not going to overutilize, you're going to make your payments on time and all that stuff. And when it comes to different types of credits, we're looking at 3 different types. So there's really 2 primary ones, which are 2 that we've talked about a lot today. So your revolving credits, which is going to be your credit cards, your lines of credit. The revolving credit is, you have this much money, and you can borrow from it and pay it back, borrow from it, pay it back. You can do that, as long as you want. Your installment credit, those are going to be things like your car loans and your student loans. where you're given this amount of money and you make an agreement that you're going to pay back this specific amount every month for the next 5 years or however long. That third type of credit, that is called CRE, which stands for Consumer Real Estate. And that is getting into mortgages. And so with these different types of credits, it's also going to be different levels of trust. So again, coming back to that trust. So with revolving credit, it is, can I trust you to manage your spending, not overutilize, make your payments? With installment credit, it is, can I trust you to make this commitment for the next 5 years to pay this amount back every month for 5 years? And then when we get into mortgages and the CRE, that is a whole other level of trust. So it's one thing to say, I'm going to give you $25,000 and you're going to pay me back every month for the next 5 years. It's a whole other thing to say, I'm going to give you $400,000 and expect you to pay me back every month for the next 30 years. All right, that is just a whole other ballpark. And, because it's a whole different type of trust for those mortgages, that is what's really going to help push you into like that 800 range, with your credit score, just because, it's such a high level of trust. But the more of a mix that you have, the more that is going to help your credit out. So let's go back to installment loans. All right, let's say that you are trying to get a car. So what do y'all think is the best-selling car brand in Colorado?
Real quick, while you guys are all throwing that in the chat, I just want to quick kind of summarize that, throwing it back to Lori's original question as we jumped into this, why your credit card is so necessary to get to that high-end score. You can't get that excellent score without it. It's because when you look at these sections, without utilization, without that card or that line of credit, utilization, that 30% of your score doesn't exist. Your length of history, your credit history falls off every few years, and you can never really build it up past that 10 mark. And your credit mix is missing a crucial piece to say that we can trust you in every single way. So really, you think of the total number there, and it's 45% of your score that's being largely impacted by that credit card or that line of credit. That's why it's really hard to push up into that excellent range without it. So I just want to make sure I got that summary and made it as clear as possible. Also, though, Katie, for your information, pretty much the entire chat is just lit up with varying degrees of full capitals and exclamation points saying Subaru.
Yeah, Subaru. I love my Subaru. You're correct. All right, so we're looking at Subaru. So a new Subaru Forester. So base model, before you add all the fancy stuff to it, we're looking at starting price right around $25,000. So have you ever thought about how much your credit is impacting the total cost of that vehicle? All right, so we got our $25,000 car with a 5-year term. And, let's say that you've been taking really good care of your credit, and that is awesome. The amount of interest you're paying, really isn't too bad. But let's say you've hit some bumps along the way. Maybe you've mismanaged some things, struggled with your payments. And y'all look at the poor credit line, which first, like Mike said, there's a good chance you might not even get approved for that loan. But you were spending over $15,000 just in interest to get the exact same car. And still that middle level, it still kind of hurts my feelings a little bit how much interest that we're paying on there. But, it's kind of mind blowing to see, how much your credit is going to impact buying something like a car that a lot of us need, to get to our jobs and everything, and how much more interest that you're going to be paying. And so this is just for the 5-year term. So let's say you're looking to extend it out to 7 years because those monthly payments are looking a little scary. Extend it out, it might go down a little bit. Is it worth it? Is it going to make a difference? I'm going to turn it back over to Mike here. He's going to walk us through what that's going to look like.
So when we're looking at something like this, it's already insane. right? You think about, all right, so I want $25,000. It's going to cost me, best case scenario, $27,000. Worst case scenario, $40,000. But a lot of people fall into the trap when they're going out and getting a loan, or they're going out and getting a car, and they say, well, really want this car, but that's going to be kind of tight on the payment. So I'll push it out a little bit. 84 months is a common thing that people end up doing nowadays. The average term for a loan was almost exactly 60 many years ago. And over time, it's just been getting longer and longer and longer as people are prioritizing that monthly payment. The problem with prioritizing that monthly payment is that with longer loans comes more payments and comes higher interest rates. So we're seeing that to the extreme here. Instead of paying a little over $2,000 in interest, best case scenario, paying almost $4,000. All right, nearly $2,000 of additional interest just from going from 5 to 7 years. Or when you think about that D credit, when you're having to go through a subprime lender, you could be paying for that car twice. You know, I think Subarus are cool too. I don't want to pay for 2 Subarus just to have 1 Subaru. All of these things matter. So make sure that we're focusing when we're making these financial decisions on the long term. You know, this is a 5-year commitment, a 7-year commitment. Make sure that you're taking this into account and looking at what that really costs over the 5 years or over the 7 years, rather than trying to fixate too much on that monthly payment. Sometimes it's worth it to wait, or to push more for down payment to get that payment down monthly instead of extending your term. There are a lot of things that go into that. The other thing we want to really wrap up our class with is talking about the other side. This is installment loans, that 5-year, 7-year, up to 30-year commitment. What about that month to month? What about that credit card that's so important to get your score up? Katie teased it multiple times there, talking about why all of our parents said, pay on time or pay early. A lot of them probably said that without ever realizing why that's a thing. And the reason that it's so important to have this idea of pay on time or pay early is because of the difference between your billing cycle and your statement cycle. So when we're spending money throughout the month, we're getting basically these mini loans, right? That's the way to think of a credit card. It's these mini loans. We're going to give you the money right now, you pay us back at the end of the month. Or if you really want to make the credit card companies tons of money, you can pay them back over the next many months. The idea is use it and pay it back. So we get that. And let's say it's the simplest thing ever. And our actual statement cycle says from the 1st to the 30th, you spent $2,000. And it's due on the 15th. Make sure you get that payment in. So you paid on the 15th, but you're someone who tracks your credit. You go in, you say, my score went down. I have a $2,500 limit on this card. I spent $2,000. Why did my score go down? I paid it in full. Well, because your statement cycle and your billing cycle are different. So your statement cycle said pay it by the 15th. We talked at the beginning of the class there, though, that it's when are these being reported to the bureaus? So that Discover card or Chase card or whatever card you're using may actually be sending what your current balance or usage is on the 13th or on the 12th. All of these things come into account with that. So even though you're paying it in full, it's looking like your utilization is much higher than it is. So the idea of pay on time or pay early, paying early is the best thing you can do. The way to make sure you're doing it just right, call your company and ask, what day do you report on? What day are you sending my utilization or my capacity to the bureaus? Because it's not information that they make readily available. No, that'd be far too simple. So a lot of times you do have to call, but it's worth the call because it can boost your score immensely and save you from a lot of heartache. Just paying that a little bit early can make a world of difference. You see, we've got a couple things here in chat. So they report monthly, have a tracker on your account. Yep. So I put in there, there's some different places. There's really a lot of them out there. As far as what's the best credit card for any given person, it's going to be dependent on what are your needs. For me, I drive a car that's not fuel efficient at all. Like 14 miles to the gallon. Katie always shakes her head at me. So for me, I need a card that gives me 5% back on gas because I spend a lot on gas, especially over the last few months when suddenly gas is going crazy in cost. $80 at the pump. I want a little bit of rewards back, something. For my wife who has an Amazon package show up at the door every single day, that's a great card for her. Sometimes if your income is fluctuating a lot and you're struggling to make those payments every month, because some months are looking really good and some aren't, maybe don't look for that rewards card. Maybe look for a card that just has an excellent interest rate. So those months when things are tough and you can't pay it all, it's not costing you as much to have to wait to make that payment. So all of that is going to be the little things that you can consider when you're trying to pick out that perfect card to make your finances work better for you. See another one in here, you were advised to put all of your subscription services, so Netflix or Amazon Prime, onto your card and then put it on auto pay, not really using the card outside of that. It's a really painless way to build your score. And that's absolutely true. For some people who don't like to use that card on the day-to-day basis, then just making sure you're using it, right? So you get that payment history built up, you keep your card active. All of these different things can add up to building up your score in a positive way. Also, if that's all you're using it for, means that likely you're never going to have to worry about utilization, even if there is some kind of computer error that makes it so you end up a little bit off. We can't account for everything, so the best we can do is try and account for everything that we can. What are your thoughts on secured cards? They've been recommended to me before. So we'll actually be touching that here in just a second. So I want to make sure we're getting through this. I want to be respectful of all of your time. And that is going to be a big thing of what we touch. So the quick do's and don'ts when we're thinking of our credit cards, treating it like cash. It's the best thing you can do. Never put more on there than you can afford to pay off at the month. But that's just the first one. There's a lot more things to keep in mind. The first, other ones are going to be treating it like that mini loan. That's how you got to keep it in mind, right? You're borrowing someone else's money so you can go and pay it back. Never use a credit card to finance or fund extravagant purchases, right? If it's not going to be paid off this month, don't do it. A loan, taking out a personal loan or something like that for that big vacation or that big purchase will be a lot cheaper for you in the long run, just due to the difference in interest rate. A card can be 17, 20, 25%. Personal loan could be 7 to 9, maybe 11%. And as you guys saw a couple slides ago, that interest rate can really add up very quickly. When we're thinking about all of this and it's coming together between the revolving lines and the installment lines, and we're thinking, all right, how do I really build up that credit score? We're looking at using those accounts responsibly, keeping track of all 5 of those things. Utilization is low, making sure you make all your payments, that you're keeping your length of history, not letting it fall off, and that you're using different types of credit. Never charge off more than you can pay. The low limit credit card, that's really just this idea of more for borrowing. When you're looking to be approved later on, you don't want too much risk associated with your name. And if you've got multiple cards that have these big balances that you're not using, it's still considered possible risk. So keeping your credit card balances to a reasonable amount for what you need in your life. Make sure you're spacing out those applications at least 6 months whenever possible. And then a share secured loaner card is great. If you do have that lower income, if you do have a lower score, share secured cards are basically where you're putting up the collateral. You're saying, I've got this. You can trust me, because if you don't, and if anything goes wrong, you've already got my money. Right? It's paid in advance. So when we're thinking about this, that share secured loan or share secured card or secured credit card, all these can be very beneficial to guaranteed approval, better interest rates, and just moving that score in a positive direction. And again, pay on time or pay early. We can't say it enough. Last thing I want to leave you guys with is going to be how to track your information. Primary way to get your full report and see exactly what those lenders are seeing is to go to annualcreditreport.com. It's the only one that's actually authorized to give you your full report, not a partial report. You can get it one time per bureau per year. So spacing those out about every 4 months, you can make sure that what you're seeing on there is in true to what you are actually doing. It's the best way to spot fraud and to make sure that you're moving in a positive direction. As for the actual score tracking, it's going to be a whole nother thing. There is your Credit Karmas out there. There is your My FICOs out there. The one that we partner with, or the one that we can talk about really, is going to be the Savvy Money side of things. It's just a website like many others, or an app like many others, that can help you track your score from month to month. The beautiful thing about this one, though, is that it does give you a partial report, so you can see exactly what's reporting, how's your payment history looking. Then it grades those 5 scoring areas that Katie talked about today. So they'll say your payment history is an A, your utilization is a B, your credit age is a B, but your balance and things like that and your new credit are both A's. Then it's going to give you little tips and tricks saying, all right, if you want to get to that next level, utilization is what's holding you back. Try and get your balances under this amount in order to push your score as high as possible. All of these little things can come together into building up that score as much as possible. It's kind of like having that little miniature financial advisor in your pocket. So there's a lot of different apps out there. This is just the one that we like to talk about because it's the one we're most familiar with. But finding a tool like this to make sure you're tracking your credit so you don't get surprised when you do go apply for that card or apply for that car. That is pretty much everything that we have for you today. Again, I want to be respectful of that time. There's tons of additional resources out there. You can always reach out to us directly as well if you have any questions. We can also stick in here for a little bit longer if some of you have more questions. We can cut the recording and all of that, so YouTube keeps it on time. But want to make sure that we're here to help. That's what we want to do, and we're here to pass on as much information as possible. So I hope you guys all have a wonderful, wonderful day.
Thank you, Mike. Thank you, Katie. Oh my gosh, I learned so much. This was such a great presentation. Thank you for this information. Once again, we'll be sharing this recording. We hope you all can join us next week as well, same time, Thursday at noon, for the 3rd webinar in this series. We're talking about big financial forks in the road. You all have been great in asking such great questions. Thank you, Mike. Thank you, Katie. Thank you, Ent Credit Union, for sharing this information today. Hope you all have a wonderful rest of your day. Thanks.
Bye, thank you.